there to help make any kind of gifts that are needed to be made, any kind of lender complicated. And then sitting back over there, she's waving to you. That's Ellen. She is our new vice president for advancements. We're very glad to have her. She just started a few weeks ago. Welcome. We had asked Ken Turpin to speak for us today, but he last minute was unable to join us. So Jonathan Journey has stepped in. He is an attorney. Well, he's an alum, which is very important, but he's also an attorney. He graduated from Southern in 07 with an accounting degree. He got his CPA after that. Then went to California to go to law school. He practiced out there for 10 years. Is that right, John?
Yes.
And recently has relocated back to Tennessee to the Crossville area. And so he has agreed to step in and give a presentation. I think.
All right.
Let me say quick prayer.
Yes.
Dear Father, thank you so much for this opportunity to be here with Jonathan and you, that you would bless this time.
Thank you. All right, so this morning we're going to talk about different planning strategies, how to plan tax savings, working with charities. Before we do that, great verse here, without counsel, plans fail, but with many advisors, they succeed. So it's important to get many advisors. I'm also, one thing she didn't mention, I'm also the vice president of American Christian Ministries, used to be American Cassette Ministries. But we got rid of the cassettes because no one uses cassettes anymore. So we have an app now. Just full plug for ministries. Download the app, great stuff you can listen to on your drive home about different presentations on the Bible. Okay, so before we get into the different strategies, let's talk about some of the different estate planning tools, things that you use. You'll know about a will for you to write and give your bequest to your beneficiaries and heirs. There's also durable powers of attorney that covers your finances while you're alive, so that someone can make financial decisions for you. So, for example, if something happens to you, you're incapacitated, or you have Alzheimer's and you need a child or a trusted loved one to make decisions for you, that gives them the power to do that. There's a healthcare power of attorney. So the durable power of attorney covers financial decisions. The healthcare power of attorney covers your health decisions. So you can name different people. Maybe one child's a doctor and the other child a CPA, and so you give one the financial decisions, the other one the healthcare decisions, or whatever you're most comfortable with. And so that would give that person the power to make medical decisions for you if you are unable to. You want to make sure all these are part of your estate plan. There is something called a tangible personal property memorandum, and that's a way to give your personal property things that are tangible, like maybe your watch, or some family photos, or something that's important to you that you want to go to a certain person. And so as long as you reference that document in your will or trust, you can write on it and sign and date next to it, whenever you want. You don't have to go to an attorney to get that done. So a lot of people like that. The item has to be, depends on state law, but in California, the item has to be under $2,000 in value. And so you can say, I really enjoyed grilling all these years with my son. I really want him to have a barbecue. So you write that on there and give that to him. Deeds, you want to make sure that your deeds are properly worded and properly funded into your trust. If you have a trust, so that your trust is working properly. Of course, the revocable trust, another part of the plan, and that helps you avoid probate. It's also private. So if you have a will, remember a will is instructions to a judge telling him this is where I want my assets to go. And so the court is overseeing that process. So you're going to pay all the probate fees. It's also public. Anybody can go look up anybody's will. Anybody have a guess of the most viewed will in American history?
Okay.
No, well, no one's seen their will yet because they haven't died. So the will doesn't get filed until someone passes away, but it's Jackie Kennedy's. She did not have a will. I mean, she didn't have a trust, so everything she had went through her will. And so people go look up, hey, we've got this of the Kennedys, try to track down memorabilia or whatever. And so you can go up there to New York State and look up her will if you want to see who got what. So if you have a trust, you avoid that. And then, your heirs or your spouse won't be preyed on by others who see that, hey, she just inherited, $2 million or, whatever they're getting. And so it's a way to have that privacy, have that protection, also avoid court oversight. And there's other specialized trusts that help. Yes, sir.
We have a living trust.
Okay.
When it says revocable, what does that mean? How does that change a living trust? If ours doesn't say that, does that have any significance?
No, so if you have a living trust, revocable means that you can change it. As long as you're alive and you have mental capacity, you can change it. Now, there are other types of trusts called irrevocable trusts. Now, it doesn't mean they have to physically say that in the wording, but in the language of the trust, it will say this can't be changed. And so people do that for different tax reasons, for tax planning and or other strategies. If you have a child with special needs and you want to avoid government programs invading the assets, you can do it in an irrevocable trust and set it up in a certain way.
So we need to read through it and find out what kind of words they use, like revocable or irrevocable.
I would bet yours is revocable if you don't know. It should say it in there that you can change it. The grantors can change this or amend it at any time. So as long as you have that power, then it's revocable. And so if it's revocable, it's still included in part of your estate. And so it could be subject to estate tax depending on the value of your estate. Right now, the exemption is like 11.7 million. So a lot of people don't have to worry about that. You do, that's a wonderful thing. And that's per spouse. So, between spouses, they have, 23, 24 million they can pass on. But of course, we know all that's being changed right now, Biden, and we don't know what will happen, but there's right now, I think it was the House brought it down to 6 million or 6.5 million, but the Senate, Bernie Sanders wants to bring it down to 3 million, and we'll see what happens as it unfolded. So stay tuned. So then with an irrevocable trust, you can do, more tax planning. Like if you gift it to an irrevocable trust, you can't change it. So you're getting it out of your estate. And so then it wouldn't be subject to estate or gift tax, depending on how it's structured. But there's also another type of irrevocable trust that we're going to talk about, and that's the charitable remainder trust. And so this is a way to give assets to charity and to get a charitable deduction, also to get income from the trust, as well as avoid income tax and capital gains tax, depending on the type of asset that you put into it. Okay, so that's some of the tools. Now, some of these tools we use while we're alive, and some we use after we pass away. So while you're living, we use the powers of attorney, durable power of attorney, which is covered in financial decisions. So once you pass away, if someone has a power of attorney for you, they can't use that anymore after you pass away. Same thing with the healthcare directive. Once you pass away, your healthcare directive is no longer valid. Now you want to make sure that says durable if you have a power of attorney, because if it's not durable, then once you lose mental capacity, that person wouldn't have the ability to act as your agent. Okay, so you want to make sure it's a durable power of attorney if you want your agent to be able to make decisions for you while you're incapacitated. There's guardianship and conservatorship. That's through the courts. That's expensive, but that's tools that you can use while you're alive. Annuities you can set up to give you an income stream. Of course, different trusts would be while you're alive. Certain gifts, gift planning now, and charitable giving are different tools that we can use now to help with estate tax. So here's tools that you use after you pass away. You have the estate tax exemptions that you would use to help avoid the taxes. You have your wills that operate after you pass. You have trusts that they work both while you're alive and then as well after you pass. Different ways properties are titled will affect how they're passed on. Beneficiary designation. So if you go to your bank, you can put on your bank account that's payable on death. And so then that avoids the whole probate process. It avoids your will and your trust. And as soon as you pass away, your heir can go in with a copy of the death certificate and get access to that bank account that they've been named the beneficiary of. Of course, we know life insurance is something that only goes into effect after you pass away. And then also that personal property memorandum would then go into effect to give away those personal assets. So here's a little chart I did to help understand it more. So the ones that work while you're alive, for your non-trust assets, any assets that aren't in your trust, all those decisions are through the powers of attorney. So your financial power of attorney would handle all non-trust assets. So that agent can talk to the IRS, they can talk to any bank account that's not in the trust, handle that bank account. They can talk to, they can file lawsuits on your behalf or defend you if you're sued and you have lack capacity. So all that would be handled by whoever you name as your power of attorney. Now for your trust assets and trust decisions, that's whoever you name as your successor trustee. So most likely you're the trustee of your trust, but when something happens to you and you become incapacitated or pass away, then your trustee would make those decisions for you. So that's while you're alive. After you pass away, your non-trust assets are all controlled by your will. So this is why you need a will as well as a trust in case you leave any assets out of the trust. And so whoever you name as executor, yes.
Pour over will, you familiar with that term?
Yes.
And so that takes care of that.
Yes. Yeah, so a pour over will is a type of will. It just basically means everything I have, I pour into my trust. You can imagine a bucket of water and you're pouring it into a trust. If a trust is a physical object. And so a pour over will simply says, everything I have, I give to my trust. And so then when you pass away, if you left anything out, then your the will would be probated, that asset would, and it would then be transferred to the trust, and then the trust document would control. So a pour over will is kind of like a spare tire. How many of you want to use a spare tire? Nobody, right? You don't want to use a spare tire, but we like that it's there, right? Just in case. And so that's what a pour over will is. We don't want to use it. We don't want to go through probate. We don't want the expense. We don't want the publicity. It also takes a long time to go through the probate process. So we don't want to use it, but we like that it's there just in case because we want our assets to go according to what our trust says. And so that's what a pour over will is. Okay. So a lot of people ask me when I do their estate plans, who do I give my estate to? What do I do? Well, I can't really tell you what to do, but we do have counsel on it. Some people say, should I give it equally or unequally, immediately, or delayed? Maybe wait till my kid reaches 30 or 35 or whatever the age is. You can attach strings. I had a gentleman, or a couple, and they had a son who was in his late 40s that was still living at home. And he didn't have a job. And so they were kind of frustrated. And they said, we don't want to just give him our estate. And I was like, well, what can we do? So we thought of a way that we said, well, let's have the trust match his income. And so what he has to do is he has to submit his monthly pay stubs, and then the trust will give him a check that matched that monthly pay stub. And so they like that plan, so they went with that. So he went to work and made $100 that month. The trust would write him a check for $100. He went to work and made $5,000 to check. The trust would write him a check for $5,000. And so it encouraged and motivated him instead of enabling him. So you can attach different strings. You can build in substance abuse provisions to trust so that the trust, instead of using the funds if a beneficiary has a substance abuse issue, the trust will use their portion of the funds to get them help. And then once they've been sober or no longer have the addictive problem, then they can get access. And so you can build in these different things depending on what's right for your family and what they need. Keep it in the family, give it to a school, church, or charity, leave outright or keep it in trust to provide different protection. And so this is an important decision, right? Ellen White talks about how this is your last act of stewardship by giving through your estate plan. Here's a couple Bible verses. There's actually a lot of Bible verses that talk about estate planning and all. But here's a few. Moreover, it is required in stewards that a man be found faithful. So just remembering, that as you're doing your estate planning, that you are a steward, that God has blessed you with those funds, and to be faithful. I think 1 Timothy 5:8 says, if any provide not for his own, and especially for those of his own house, he hath denied the faith and is worse than an infidel. And so if someone's in need, there's counsel that we should take care of our family that's in need. There's other proverbs that say, blessed is the man who gives an inheritance to his grandchildren. So I like to tell my grandparents that one. Remind me of that Bible verse. But yeah, so there's different counsel in the Bible. So if you're at this point where you're making plans, you should pray about it. There's some counsel from Ellen White as well. She says property is often bequeathed to children and grandchildren only to their injury. They have no love for God or for the truth, and therefore this means all of which is the Lord's passes into Satan's ranks to be controlled by him. And then there's another one from Adventist Home. In disposing of your property by will to your relatives, be sure that you do not forget God's cause. You are his agents holding his property. His claims should have your first consideration. Your wife and children, of course, should not be left destitute. Provision should be made for them if they are needy, but do not, simply because it is customary, bring into your will a long line of relatives who are not needy. So she gives us counsel. There's a whole chapter there in Adventist Home. If this is something that you're interested in, to go and review and read and pray about what you're supposed to do with your estate plan, and God will give you direction. Okay, so why do people give to charity? Well, a lot of times people give because they believe in the nonprofit, they believe in the charity and its mission and what it's doing. They want to be faithful stewards. And people also give because of the ease of giving. So we want to make giving easy and make it make the ability to give easy. And so there's a lot of ways to give that we're going to talk about that help your estate plan, help save with taxes. And we're just going to talk about these 5, and these are kind of the big 5 ways to give today. And so it depends on whether you need income or you do not need income. And so if you don't need income, there's ways that you can give to charity, either by giving an instant gift, and just gifting funds or assets. Also giving through your retirement account is another way to give, and this will help save tax dollars. If you need income, there's certain ways to give where you can actually get an income stream. So you can turn non-productive assets into income-producing revenue. And that's through either a charitable gift annuity, charitable trust, or a bargain sale. So we're going to talk about each one of these right now. So the first one is an instant gift. So an instant gift is when a donor wants to give assets now. So maybe you have an asset, you want to give it right now. You feel impressed, or you like what project they're working on or something, so you want to give this now. You can get a charitable deduction for that. It will reduce your estate tax if you would have been over the estate tax exemption amount. And so you want to make sure, though, that you give the right gift, and And so, it's not necessarily that you want to give cash. If you have another asset that might be better, you want to make sure that you look at that. So maybe you're wanting to donate $100,000, and you have stock worth $100,000, but you also have cash worth $100,000. And so you want to make sure that you give the right gift in order to save yourself taxes. And so we're going to do a little example here. So you have stock that's worth $100,000. If you give that stock to the charity, so you directly transfer this, say you bought Apple stock 20 years ago, and instead of giving cash of 100,000, you wisely give that stock, that Apple stock you bought for pennies 20 years ago, you give that $100,000 worth of that. Now you don't sell it, you just give the stock directly. You can transfer it to the charity's account directly. And the charity can sell it, and charities, they don't pay taxes. So they can sell it tax-free and they get $100,000. Now, if you said, you know what, I really want to give this charity $100,000, I'm going to go sell my Apple stock and I'm going to give them the proceeds. Well, if you did that, if you took the stock and you sold it and then you donated the money, you would actually be only giving the charity $85,000 because you are going to have to pay $15,000 of capital gains tax. So you want to make sure that you transfer first the right asset, and you transfer it in the right way. So if your asset has gone down in value, then you would want to sell it because you would want to capture those losses on your tax return. But if your asset has gone up in value, you would want the charity to sell it. So you'd want to transfer that asset directly. So you want to make sure that you work with the charity before you take any action to sell or donate property. Okay, so that's giving instant gift. Another way to give is through your retirement account. And so if you don't need the income and you don't want to have to take your required minimum distributions, you can give from your retirement account, for example, an IRA, 401k, 403b, any sort of qualified account. Remember, those are pre-tax dollars. So this money went in and you have never paid income taxes on these dollars. And so when you take it out though, at age 72 or 70 and a half, depending on how old you are, you're required to take out a certain amount each year. And you're going to be taxed on that. And maybe you don't need the income. And so you can instead transfer those assets or those required minimum distributions directly to a charity, and then you don't have to pay income taxes on that. Yeah, we already kind of talked about this. This is how those retirement accounts work. They're pre-tax contributions. They grow tax-free. There's penalties if you take them out early. Yes.
Quick question. The transfer of like a 401k or IRA, can you do that before hitting your 70 and a half?
No, you have to wait
do that
until you're able to. Well, I mean, if you're able at 59 to start taking distributions, you can at that point.
Otherwise, you have to pay all the capital gains, essentially.
Right.
Pointed out.
Right.
Okay.
Yeah, let me think about it. You might have to actually wait till 72 if you want to give it directly to charity. I think if you're under that, but if you're at 59 or whatever, the age is for you to get it out. I'm not sure if you can give it directly to charity at that point. I'd have to look into that. Yes.
Yeah, and the thing is with the, taking money out of retirement, if you do that, it's going to be taxed at ordinary income tax rates rather than the lower, more beneficial capital gains rate. Because since you're in an IRA or 401k, it grows, and then you pay taxes when you take it out. you avoid the capital gains, because, transactions happen from time to time within your 401k, and if you had to pay capital gains every year, then, well, it'd be like you didn't have that jacket, if you will, of the 401k.
Yes, thank you. Yes, right. The payouts are at your ordinary income level, so whatever your tax bracket is, the distributions you take, you're going to be paying income tax with that. Okay, so beneficiaries, anybody can be a beneficiary, both charity or family, of your retirement accounts. You can also change the beneficiary at any time, as long as you have mental capacity. Now, in some cases, you might need spousal consent if they have a right to the retirement. So yeah, you have to start taking it at age 72. And you can start taking it at age 59 and a half. And then the IRS has set the required minimum distributions that you must be taking at age 72. It's based on life expectancy. So there's a table that they have that you can look that up. Any money that you withdraw from your IRA, of course, is included in taxable income unless you transfer it directly to charity. So you can give up to $100,000 per year from your IRA. Now this has to be from an IRA. You can't give it out of a 401k. So you need to roll over your 401k into an IRA. And then from your IRA, you can give it directly to a charity. You want to make sure that if you're doing this, whatever amount it is, up to 100,000, of course, spouses, couples can give up to 200,000. And so you want to make sure that the check is written directly to the charity. And so when that happens, you don't ever have to report this on your income tax. So remember, they raised the standard deduction, what was it, 3 years ago or so? And so a lot of people, they don't itemize anymore. Well, you don't have to itemize to get this benefit, okay? This avoids your income going on your tax return at all, because you're giving it directly to the charity. So you can still itemize, and you can still also give to charity, and you never have to report this income. So there's that benefit. But it can't be to a donor advised fund. It's got to be directly to the charity. So if a child's a beneficiary of your IRA, you might want, and you're wanting also to give to a charity, you might want to consider changing that and making the charity the beneficiary of your IRA and giving your children or child part of your estate, because your child is going to pay taxes at their income tax rate for their withdrawals. So if a charity is a beneficiary, you bypass estate tax and you bypass income tax. And so you can transfer your IRA to a charity, all of it, you can do part of it, whatever you want, and that all goes tax-free. So you can give more dollars if you give the right assets to the right people or entities. Yes.
When my mother died, I inherited stocks, and I didn't pay income tax on that.
Yeah, you wouldn't, unless it was in a retirement account.
No.
Okay, yeah, so that would have got to step up in basis, and as long as, until you sell it, you wouldn't pay any taxes. You'll never pay income tax, so you would be paying capital gains tax.
What is earned after I received it?
The increase in value after you receive it, yes, correct. Now the Biden administration right now, part of the tax plan is they're talking about being away from that step up in basis. And so you would, if that passes, then, if your parents bought the stock for $10 and now it's worth $100,000, instead of inheriting it at $100,000 and that being your basis would be their basis of $10. And so when you sell it, you're going to have a huge capital gains tax bill. And so they're talking about getting away from that step up, which could be a big problem, a big tax hit for a lot of Americans.
What? No matter what your tax, no matter what your income is and what you're worth, doesn't matter what you're worth.
Right.
Whether it's $50 or $50 million.
Right. Mm-hmm. Yes.
And so something that, as you're retiring or whatever, like we had a client earlier this year that had an estate and we did their estate tax returns for them, and then they found out, oh, by the way, if you pay estate tax, it's gonna be 25,000. If you treat it as individual income tax, it's gonna be 18,000. They were shocked and surprised by that, because they'd already distributed the estate, and so they're gonna have to pony up some money. So one of the things that we can do is we're preparing for that. It's a tremendous gift to your kids and, to your heirs if you have it like in a Roth IRA, because then you've already paid the taxes as you contribute to it. So let's say, for those of us that are 30s, 40s, 50s, if we're contributing and we pay the taxes now on what we put in, let's say that $5,000-6,000 a year turns into $1 million when you retire, which is very reasonable to expect, especially if you're doing it over your working lifetime. Then you pay taxes on $5 or $6 grand a year, or you pay taxes on $1 million later. Kind of like the idea of paying taxes on 5 or 6 a year rather than paying taxes on $1 million later. And when your heirs inherit it, they don't have any tax implications because the growth is tax-free, at least under current law, which Biden and his folks only know what they're going to do with that.
Yeah, so there's, like a Roth IRA, there's different strategies you can use to pay taxes there. Here's a little example of how to get through your IRA the right way. So this is Freddie Father. He has $450,000 of other assets, and he also has a $100,000 IRA. And he wants to give to Sammy, his son, and he also wants to give to Southern Adventist University. Remember them in his estate. So bad transfers. He say, you know what? I want to give $100,000 to charity, but he named his son as the beneficiary of his IRA. So that goes directly to him. And then he gives a portion of his assets, $350,000 to Sammy, and the $100,000 to charity. The charity gets the $100,000, and they're happy. But Sammy, he only receives $415,000 because he's going to have to pay income tax on that $100,000 he got there from the IRA. So there would be no estate tax, but there would be full income tax on that IRA. So what he could have done, Freddie Father could have said, you know what, I'm going to give that $100,000 to Southern through my IRA, and then give all my assets to Sammy, my son. And then charity receives $100,000, Sammy receives $450,000, and it avoids all estate and income taxes. And so you want to make sure that you look at what assets you're giving and how you're giving it, and make sure you're giving the right assets. Okay, so we like win-win transfers. A win for charity, a win for you, a win for your beneficiaries. And so you want to, gift assets usually that are appreciated. If you're splitting, if you're giving some to charity and some to your heirs, give those ones that would be subject to income tax to charity because they're not going to pay the income tax, and give the other assets that appreciate in value. As long as we have to step up in basis, it's best for those assets to go to your children. Okay, now we're going to talk about charitable gift annuities. And so this would be if you need an income stream. And so charitable gift annuity is a contract that you have. So if you open up a charitable gift annuity with Southern Adventist University, you have a contract with them that they're going to pay you a certain amount every, you can do it by month, quarter, or a year. And that amount is set by the IRS based on your life expectancy. And so then so you transfer the funds, whatever it is, $10,000, $20,000, $100,000, put it in that annuity. And then Southern would then send you a check every month for the percentage based on what the IRS table says. You would get a tax deduction, an immediate charitable tax deduction that you can take on your 1040. the following tax year. And also a portion of that income stream that you're getting every month would be tax-free. And you can do it for one life or two lives. If you're a spouse, you can do it for both your lives as long as both of you are alive. And then once you pass away, then the charity or Southern in this example would get to keep the remainder of what's left. Now, hopefully they've invested it and it's growing at the same rate as the amount of distribution, and then they have full principal there for the school to use. So how much does it pay? This is the current rates. These rates change. Right now, if you're 70 years old, it would be 4.7%, regardless of whatever amount you give. 75, you're looking at 5.4, 80, 6.5, etc. So, if it's two lives, if it's based on, you and your spouse, these percentages are going to be a little lower. That's something that you could look up or have them look up. Okay, the tax advantage is there's no gift tax. You're not going to pay any gift taxes. There's no current capital gains taxes. So instead of selling that asset, if you needed income, and you wanted to sell that stock, you're going to have a big capital gains tax bill the next year. Well, this way you can stretch out the capital gains tax because you're only going to be paying them over the increments of the years that you're receiving the payments from Southern. And then you also get the current charitable deduction. The payout, like I said, the payout is partly tax-free. It would be partly ordinary income. And if you use an appreciated asset, it would be part capital gains as well. Now, after you outlive your life expectancy, then the IRS says, okay, now everything would be ordinary income. So if your life expectancy is 90 years and you live to 95, those last 5 years you're getting that annuity payment would be subject to ordinary taxes. So here's an example of how that works. We have Freddie Father again. He's age 77. He has $20,000, and it's not producing any income for him. So he decides to set up an annuity with charity, Southern Adventist University, we'll say, and he gets 5.8% based on his age. And so he would get $1,160 a year on that $20,000 gift for the rest of his life. About 900 of it would be tax-free, and then 261 of it would be taxable. He'd also get an immediate, almost $9,000 charitable deduction that he could claim on his tax return. Then after he passes away, the remainder would all then go to charity at that point. Okay, now if you use an appreciated asset, that was cash, something like stock or a rental property or something like that, then a part of the payment would be capital gains as well. So here's an example with two people, Freddie and Mary. They both met at Southern Adventist University and Southern Matrimonial College or whatever it was back then. And so excited, we've had such a great life and we're so thankful. We want to give $200,000 of that Apple stock we bought in '95 for $40,000. And so right now they're receiving a 1% dividend. So they're getting about $2,000 a year. And said, you know what, we're retired, we need a little more income than $2,000 a year. What can we do? And so they call up Southern's Plan Giving Department and say, how can we turn this into more income? And so what they do is they set up a gift annuity. They get 5% based on their ages on the IRS table. They transfer that $200,000 directly. Remember, they don't sell it and then transfer it. Otherwise, they're paying the capital gains tax. They're going to transfer that directly to the charitable gift annuity, and the charitable gift annuity will then sell it, and they'll get $10,000 a year. 1,600 of it would be tax-free. 6,600 roughly would be capital gains, and then 1,700 would be ordinary income in this example. They're also going to get $80,000 charitable deduction that they'll get to take against any income. And then after they pass away, all the remaining amount would then go to charity. Okay, so the advantage of this to a donor is that they get that current charitable deduction. They get fixed payments for their life, that fixed income stream. They get part of it's tax-free. They can spread out the capital gains tax, so maybe they're in a lower tax bracket. so they'll be paying less tax dollars. They won't pay any current capital gains tax. It's very easy to set up. So this is a nice way to turn a non-income producing asset into an income producing asset.
Is there any way to structure that so it's inflation adjusted in anything?
No. No, you're set, you're stuck on the IRS's table once you do that, once you set it up. Now, a charitable trust, you do have more flexibility. And so this is kind of like an annuity in that you get a set income stream, but it's different than an annuity. So there's different types of charitable trust. There's, kind of two areas. You have the charitable remainder trust and charitable lead trust. With charitable remainder trust, the charity gets the remainder. So you're going to be getting the income stream during your life or the lives of the beneficiaries. And then once you pass away or they pass away, whoever it is, the remainder would then go to that charity. With a charitable lead trust, it's the opposite. The charity would get the income stream. And then once you pass away, your beneficiaries would get that underlying asset. So let's look at some examples here. First of all, for the charitable remainder trust, so under those two headings, under the charitable remainder trust, charitable lead trust, there's two different types of charitable remainder trusts. There's one that's a fixed percentage, and so it's based on the value of the assets in the trust on January 1st of each year. And so you say, I want it to be 8%, and so you would get an 8% payment of whatever that value is on January 1st each year. And then there's the annuity trust, where that's a fixed amount. So it doesn't matter how the trust fluctuates, whether it's doing well in its investments or not, you're going to get a set amount each year. So those are the two different ways that you can set it up. The advantages to a charitable remainder trust is you get a reliable, steady stream of income for life, where you can set it up for a term of years, up to 20 years. You get a income tax deduction, a current one, charitable income tax deduction. Also saves, you have those tax savings, capital gains tax, income tax, estate tax savings. Here's another example. We have a Freddie father and Mary mother, and this time, instead of doing a charitable gift annuity that stuck to the IRS's table, they decided, let's do a charitable remainder trust. And so they have $40,000 of stock. It's now worth $400,000. They're receiving that 1% dividend. They want to increase their income without paying the capital gains. And so they set up a charitable remainder trust. And with a charitable remainder trust, we can pick the percentage, as long as it's between 5 and 50%. And as long as the projected distribution to charity is at least 10% of the initial contribution. So whatever amount you pick, the amount to charity would have to be at least 10% projected, so 40,000 in this case. And so that's something that you would want a professional to run those numbers to make sure it works. So you can pick the percentage they pick, let's say 7% they want for the remainder of their life. So they're going to get $28,000 a year now, whereas they were getting $4,000 a year of stock dividends at 1%. And so they just increased their income a lot. They're going to get immediate charitable deduction of $167,000, and then they'll be getting $28,000 until they both pass away, and after that, the remainder would go to charity. Okay, so here we see that their income increased from $4,000 to $28,000 a year just by making this transfer. They were also able to save about $59,000 in income tax by getting that charitable deduction, and then they would have saved about $360,000 of what you would have had to have paid capital gains tax on. And then you would also have an estate tax savings as well. Okay, now here's for a single person. Sally, this is for a home. Say she bought the home for $200,000, and today it's worth $900,000. She wants to downsize. So what does she do? She doesn't want to have to pay all those capital gains tax. So the plan is she's gonna buy a smaller home, right? Maybe in a tract neighborhood, she doesn't have to mow. Doesn't want a big yard. She also needs an income stream. She's retired now. She doesn't want to pay those taxes. So what should she do? Well, she decides I'm going to call the plan giving department, find out what I should do. Today, why don't you set up a charitable remainder trust? So she decides to do that. First key is you have to move out. You can't transfer a property you're living in into a charitable remainder trust. So she moves out and then she deeds the property to the trust. And then the trust, she needs half the property, sorry, because she needs money to buy a smaller house. So she needs half the property to the trust. So now she owns half her home and the trust owns half her home, the charitable remainder trust. And then they sell the home together. So let's look at how this works. So the home is $900,000. They sell it together. She gets $450,000 cash. $450,000 then goes into that charitable remainder trust, which she's going to get an income stream from now. She's also going to get a charitable deduction for that to pay for her half of the capital gains tax that she would have had to pay. Now she's able to buy a smaller house. She's able to give some to charity. And she also had, once she passes away, it would go to charity. And she also gets that income stream. So here's how that works. So she had bought it for 200. It's now worth 900. She has a gain of 700,000 if she had sold it herself. But she's splitting it, so half of it's going to charity, and she picks a 6% payout. So she's going to be getting $27,000 a year in income. Plus, she'll be getting the $450,000 in cash that she'll have to pay some capital gain tax on, and then she can buy her smaller home and then live off $27,000 a year plus whatever other Social Security or other income she has. After she passes away, then the remainder would then go to charity. And so she gets to get $350,000 cash free or tax free, excuse me. Remember, she gets that $250,000 homeowners exclusion. Then she gets her half of the basis, $100,000. Remember, she transferred half and she kept half. So she has $350,000 of that $450,000 that's tax free. And then the remaining amount, the last $100,000, she's gonna have to pay capital gains tax on, $15,000. But remember, that's offset by the charitable deduction. And so, she most likely is not gonna have to pay any tax at all on this transfer. She'll get $20,000 a year in income. She avoids capital gains tax, avoids estate tax, and is able to help charity as well. This is a win-win transfer. And so things that you have to think about as a donor, is the income payment, whether or not you want to change charitable beneficiaries, what amount of the annuity you're going to pick. And you got to make sure that the final projected amount is at least 10% of that value to charity for it to be a legal charitable remainder trust. Okay, now the other type of charitable trust was the charitable lead trust. Remember, that's the opposite. That is when the charity is getting the income stream and then the asset would go to your beneficiaries. So people do this because maybe they want to keep a home or rental property or vacation home in the family, but they're not using it. And so they want their heirs to be able to use it. And so they can rent it out and give the income stream to charity. And so the donor would then transfer the assets to the charitable lead trust, and it can be set up for your life or for a term of years. Also, it could either be a fixed percentage that's going to the charity or a fixed amount, just like we saw with the charitable remainder trust. And then the lead trust would either keep the assets or they can sell and invest, however you set it up. And then each year it would give the income to the charity. And so they would get a tax deduction for that. But remember, if the trust keeps any income, it's going to have to pay income taxes. So you want to try to make sure that you're giving out all the income to the charity, so it's not having to pay any income tax. Then after you pass away or after the term of years ends, you can then go to family or whoever your beneficiaries are. let's say you have a cabin in Vail that you've had in your family for many years, passed down to you, and it's now worth $1 million. And you're like, you know what, we don't make it out to Vail anymore because we're older, we don't like to fly, we don't like to ski, or whatever it is. And so you say, you know what, let's rent it out and give the income stream to charity. So they put it in a charitable lead trust because they want the asset to stay in the family. And the trust then rents it out and pays 6% to charity. So the charity would be getting $60,000 a year in income. There would be no income tax paid on that. They would get a deduction for the present value of that income stream. They would get that instant charitable deduction. And then after they pass away, the children would then inherit it, and that would pass away. Majority of it would pass away estate tax free. Part of it would be taxable on estate tax if you were over the estate tax exemption amount, depending on what that is. That's the charitable lead trust, how that works. Okay, the last option of how to, if you need money, but you also want to lower your taxes and benefit charity, is a bargain sale. And so what a bargain sale is when you sell the asset to a charity for lower than what it's worth. So you have some sort of asset, real estate is typically what is used in this situation. You would sell it to a charity, for say it's worth $200,000, you sell it to a charity for $100,000. So that would be a bargain sale. So you get a charitable deduction on part of it. You're going to save on capital gains tax, and you can set it up so that it's a zero tax transfer, so that the transfer to charity, that charitable deduction amount is the same amount as what your taxes would be, so it's a wash. So here's an example of that. You have a piece of vacant land worth $100,000. And you purchased it for $20,000 back in the day, probably just 2 years ago now. And now it's worth $100,000, 10,000 acre. All right. And so you decide, you know what, I'm going to sell this to charity for $60,000 because I need some income, and then I'll donate the other $40,000 to the charity. And so the charity says that sounds like a good deal. We'll buy it for $60,000. And so you have this land, $100,000. You sell part of it to charity, and you gift part of it to charity. And then the net amount, the cash plus whatever the net tax savings is, what would go to you. So let's put some numbers on that. So you have your basis of $20,000. It's worth $100,000. So you have $80,000 in gain. Now you, in order to get a zero tax transfer on this particular amount, you would sell it to the charity for $78,571 and gift another $21,429 to the charity. So you would be getting that $78,571 back. You would be getting a charitable deduction on that $21,000 gift, which would equal a $7,000 tax deduction, which is also the same amount of your capital gains tax on that transfer. So in other words, you would owe zero capital gains tax. Yes.
Well, if you inherited the property, so you didn't pay anything else.
Yeah, if you inherited the property, then you would have capital gains on whatever the difference is between the date, the value of it on the date of your inheritance up until whenever you sell it. That makes sense? So if you inherited it, 5 years ago, and it was, worth $60,000 then that's your basis.
How do you know how much it was worth?
You would have to get a qualified appraisal. You have to get an appraiser to do it. Yeah, get a licensed appraiser, because you're gonna have to prove that through the IRS. Otherwise they'll contest what the value is and say, no, you owe us a lot more. So you have to get a qualified appraiser and have to appraise the land or property, whatever it is, so that you know what your basis is. The best time to do it is when someone passes away. At that point, you'll get the appraisal right then. So then it's less likely to be contested. So yeah, so you would find out what your basis is, on the day that you inherited it. So yeah, so you can set this up so that it's a wash. Now, if you wanted to gift more, if you wanted to give 30,000 or half of it, 50,000 to charity and get 50,000 in cash, then you would get a much larger charitable deduction than taxes you actually owe. And so then that would lower, taxes, from other income streams that you otherwise would have paid. But you can set it up so that it's a zero tax transfer. And so now if you had sold this yourself for 100,000, you would be paying gift tax on the 80,000. And so you would, let's see, that would be 88,000 you would get. So if you sold this yourself, after taxes, you would net 88,000. So it only costs you about $9,000 to transfer $21,000. So if you're wanting to make a gift, instead of giving the IRS all the money, you can give it to charity and benefit both the charity and yourself as well. Okay, so the advantages to the donor, the seller of a bargain sale is it's convenient. You don't have to go look for a buyer. You don't have to deal with realtors. You get a cash payment and save all those closing costs. You can pick your own closing date, work with the charity. You also get the capital gains tax savings that we talked about, and you get that charitable deduction. And so those are the 5 different types of gifts, ways that you can transfer assets in your estate to help both lower your taxes, give you an income stream if that's something that you need, and also to benefit charity as well. Is there any other questions or comments?
This distribution from the IRA to a donor advised fund. Last year, I did one of those, but I was able to do it directly, and I got a statement from the donor advised fund saying they had received so much that would be deductible.
Okay.
And I didn't get a 299 from the IRA.
Okay. Was that under the 100,000?
Yes.
Okay. Great, yeah. Yeah, so that's a great way to help avoid income tax. Just transfer that directly. You just want to make sure they don't mail the check to you, but they run it out directly to the charity.
And well, maybe in this case, it was mailed to me, but the check was made out to the charity.
Sure.
And I had to forward it to the charity.
Sure, yeah. You want to make sure, be careful because it counts when it's taken out of your account. So when you write the check and you hold on to it, and you wait till after the end of the year and you don't give the charity yet, then you're going to be penalized for not taking the required minimum distributions. You want to make sure that the charity takes it and cashes it before the end of the year if you're doing this to avoid having to take your required minimum distributions. Yes.
I was just gonna say, I did the same thing. If it's made out to the charity, it comes to my house, and then I did it.
Yeah. Any other comments or questions? Great, well, thank you guys. Appreciate it.
Thank you.
We're so grateful to have you here again. The planning office at Southern Air has resources, lots of resources to help you in any of these gift plans or just estate planning. Don't hesitate to reach out. I have contact information on the table out there, and then Kenny and Robert are also available to take any questions you have. And lastly, please help yourself to some more breakfast. Thank you for coming.
Yes.